In this week's video, we'll review the latest charts and data to help us understand why recent signals say stocks could push significantly higher over the next year. We'll be moving quickly, so feel free to use the pause button on your video player. When we reviewed the chart of the S&P 500 in last week's video, despite the concerning headlines that we had a week ago, we said it was relatively easy to remain patient. All of the recent consolidation had occurred above the 20-day moving average for the S&P 500. And in the short run, patience was rewarded. First 4 trading days of the week, Monday through Thursday's close, the S&P 500 was up 2.9% for the week. The Nasdaq was up 3.7%. With the market looking forward and anticipating that it was possible that things in the Middle East were about to get better, or at least there was an expectation that the news cycle would become less bad. As a result, on Monday, stocks rallied hard and oil dropped significantly. Sentiment Trader noted that it's rare that crude oil saw an intraday gain of over 3% and then ended up closing down greater than 5%. It's only happened a handful of times, dating back to the early 1980s. Subsequent S&P 500 performance, very impressive. S&P 500 was higher in every single case historically a year later. Median gain 29.8%, average gain 12 months later, almost 38%. And with the S&P 500 closing in on a new all-time high, you might be tempted to say it's dangerous to be fully invested when the S&P 500 is near an all-time high. Well, we could have said something similar here early in calendar year 1983. And let's say hypothetically we raised 20% cash because we were concerned that the market was near an all-time high. That would have been unfortunate because walking forward from early 1983, the S&P 500 in the subsequent 16 to 17 years printed countless new all-time highs. This is the all-time high here, lower left-hand corner of your screen, early 1983. This is the same chart expanded to March of the year 2000. Simply telling us that the S&P 500 hovering around or making a new all-time high in isolation really shouldn't impact our decision-making in any shape, form, or fashion. In fact, typically, when a market's able to break out to a new all-time high, just like any other breakout, tends to lean in a bullish direction. This is the long-term version of the Nasdaq Composite Tape Index. It's compiled using numerous breadth data sets. This is a quarterly chart going back to 1989, lower left-hand corner of your screen. It's rare for the Nasdaq Composite Tape Index on a quarterly basis to drop below the center line on the Bollinger Bands, with this being the upper band and this being the lower band. In fact, dropping significantly below where we've got white space has only happened 3 times dating back to 1989. And at the end of September of 2003, we popped back above that dotted center line on a closing basis on the quarterly chart. And the same can be said for March 31st of 2010. While we still have a few trading days left in the quarter, we have the same setup heading into quarter end. Thus, it might be logical to ask and answer, how did the S&P 500 perform walking forward from the dates of the signal, 9/30/2003 and 3/31/2010? And more specifically, how did it perform over the next 1 to 4 years? Answer: in an impressive manner. 1 year later, average gain 12.65%. 2 years later, 21.85%. 3 years later, 34% and change. And 4 years later, the average gain in the S&P 500, 56.07%. And since the signal was tied to breadth data from the Nasdaq Composite, it also might be helpful to know, how did the Nasdaq 100 perform walking forward from those same dates? The answer is in an impressive manner. 1 year later, average gain 13.83%. 2 years later, 31.32%. 3 years later, 35.41%. And 4 years later, 71% and change. Simply telling us to keep an open mind about a wide range of outcomes. Now, those signals are based on a quarterly chart and a long-term version of the NASDAQ Composite Tape Index. And we know analysis becomes more powerful when we look at data sets on multiple time frames. So now we're looking at the NASDAQ Composite Tape Index using short-term weightings, the short-term version. You can see the setup in recent years, sideways consolidation here, a bullish breakout late in 2024, second half of 2024, and then what appears to be recently in 2025, a successful retest, and now we've gone on to print a higher high. You can make an argument that it's similar to this retest of the blue box in late 2016, where you make a high here, and similar to this retest of this blue box, where we went on to print a higher high here after the major COVID low. And the NASDAQ 100 is shown in the bottom panel. Thus, we wanted to know if we identified the specific date where we cleared this level and this level, which would be very, very similar to the present day, how did the NASDAQ 100 perform over the next 18 months? Relative to the two historical cases, the answer is quite well. In both cases, the NASDAQ 100 was higher 3 months later, 6 months later, 9 months later, 1 year later, and 18 months later, with the average gain looking out 18 months coming in at 57.72%. And if we use the same signal dates to see how the S&P 500 performed, the data is impressive. Looking out 3 months, 6 months, 9 months, 1 year, and 18 months, average gains roughly 11%, a hair under 14%, 20% and change, almost 30%, and 18 months later, the average gain 40.03%. A big thank you to all who have taken the time to retweet, fave, like, or comment on any or all of the social media posts that link to this week's video. It does not go unnoticed nor unappreciated. From a fundamental and economic perspective, we've covered numerous times in the past the concept that common sense tells us recessions tend to occur when people start to lose their jobs. And that's going to be reflected in this data set, initial claims for unemployment. And we've covered this chart and this trend a handful of times in recent months. And the good news is nothing's really changed. We're in the same range, tepid range, and economically strong range that we've been in going all the way back to late 2021. In recent weeks, we've covered several charts and several setups that have told us to keep an open mind about the reestablishment of leadership from tech and growth stocks. This is a monthly chart of the NASDAQ Composite dated June 26, 2025. We've got the percentage price oscillator, affectionately known as PPO, on the bottom of your screen. It is very, very similar to MACD. It helps us monitor momentum. And during the bear market in 2022, when the black PPO line briefly dropped below zero, it told us that the long-term uptrend in this window here, late in 2022, was on the ropes. So when we look at recent momentum and weakness relative to the tariff scare and subsequent improvement in momentum after the tariff news became less bad in early April, clients and longtime viewers know when we get a bearish cross here, black dropping below red, but it occurs above the zero line or the center line, it's telling us that from a momentum perspective, we treat this as a counter trend rally within the context of an existing uptrend. And if we're able to nail down the bullish cross and it occurs above the zero line, it tells us from a momentum perspective and a probabilistic perspective that the uptrend has reasserted itself. We don't have it yet, But it's easy to understand, relative to the weight of the evidence that we'll be presenting in this week's video, that it wouldn't be shocking if we saw it sometime in the next 30 to 60 days. We said we were very, very close to seeing some things that we wanted to see in tech stocks from a leadership perspective, and we're starting to see them. It's from our buddy Dean Christians. This is his X/Twitter handle down here. He does some excellent work for Sentiment Trader. This report contained several studies. We'll cover one of them. Dean looked at subsequent performance in the S&P 500 technology sector, that's XLK in the ETF world, after a deviation from a trend signal. And if we blow up the summary table, we see after similar historical signals, the S&P 500 tech sector did quite well. 12 months later, average gain 21.7%, median gain 20.4%. In 85% of the historical cases, the date shown on your screen, the S&P 500 tech sector was higher a year later. And it's important for us to keep in mind, when we have exposure to S&P 500 ETFs, so let's say SPY, VOO in the Vanguard world, and SPLG, we already have a heavy weight to technology. So when you're looking at your overall allocation, keep that in mind. SPY, for the most part, carries almost a 33% weight to XLK. It's interesting to note that the Dow Jones Corporate Bond Index recently did something that you can make an argument is worse than the financial crisis. Now, if you know market and economic history, the entire global financial system is on the ropes in here. It's a very, very serious time in the world of economics and markets. And in that window of maximum fear, because maximum fear in the financial crisis occurred in October of 2008, you can see corporate bonds made a much higher low when the S&P 500 made its final low in March of 2009, eventually recaptured an upward sloping 200-week moving average. In the present day, it's somewhat of a mixed bag. It's a very, very good sign that recent consolidation has occurred above the 200-week moving average. That would be the good news. To keep an open mind about a wide range of outcomes, news on your screen is the fact that that 200-week still is downward sloping. Having said all of that, the Dow Jones Corporate Bond Index in the present day looks a lot better than it did in 2022, 2023, and the first half of 2024. It's the Dow Jones U.S. Mid-Cap Growth Index. Again, we're using the weight of the evidence approach here. Doesn't necessarily mean we're ready to buy mid-caps. We go to this period here, late in calendar year 2012, you can see we eventually break above this long-term period of consolidation and volatility and start to move away. You can make an argument we have a similar and not as pronounced setup here. We get a bullish breakout. This looks like a retest. We go back and tag an upward sloping 200-week moving average in red, and we hold, and we've gone on this week, and we're trying to print a higher high. You can make an argument that this setup here is similar to this setup here, and if you know stock market history, both mid caps and large caps did extremely well in calendar year 2013, 2014, and into roughly May of 2015. And if you want to simplify things, the longer a market goes sideways, the bigger the move that we can expect to get. And we either get a bullish breakout or bearish breakdown. And in this case, we have what appears to be a bullish breakout. We all know that harder markets are typically followed by easier markets. We believe an important phase of the current secular bull market occurred in this window here, after the low in 2011, where in this window on the S&P 500, we eventually cleared the previous highs from March of 2000 and October of 2007. Walking forward from that period, the Dow Jones U.S. Home Construction Index has made stands typically near an upward sloping 200-week moving average in red, and those have tended to coincide with lows in the S&P 500. February of 2016, and a bout of volatility around the U.S. election in 2016 ended here. The S&P 500 made an important low in this window on Christmas Eve 2018. We know markets like to overshoot. That's what happened in the COVID case. And then you can see that same Dow Jones U.S. Home Construction Index made a stand near the upward sloping 200-week moving average during the bottoming process in 2022. This is where the S&P 500 eventually puts in its final low. Once again, that index is trying to make a stand, walking forward from the point here where the tariff news became less bad in early April of 2025. And all of this consolidation here is occurring above this region from 2005 that previously acted as resistance. What once acted as resistance may now act as support. Bank of America Merrill Lynch Research, their Global Fund Manager Survey. Fund managers are overweight the Eurozone big time, and they are underweight U.S. stocks big time. And given this appears to be, at this point, a counter-trend move within the context of a long-term downtrend in Eurozone stocks relative to the S&P 500, this is EZU in the ETF world relative to SPY. This is calendar year 2008. Here, we were rejected at the same trend line in 2009, and we're back in that same general area today. And if we look at the same ratio using a monthly cloud, despite this counter-trend rally in here, we're still checking all of the bearish boxes against European stocks or Eurozone stocks and for the S&P 500. Now, having said that, the fact that we've been near this trend line twice recently, and the fact that we're able to break into the cloud, something we haven't done recently, it tells us to keep an open mind about a trend flip in favor of Eurozone stocks relative to the S&P 500. But relative to the chart in front of us, that hasn't happened yet, and this still appears to be a long-term downtrend and a long-term downtrend. And that's a long way of telling us, if that's the case, some of these fund managers may be getting ready to allocate more of their dollars back to the U.S., potentially creating additional demand for U.S. equities. This is from Nick Timros's feed. He's the reporter that covers the Fed for the Wall Street Journal. It's a quote from Jerome Powell where he's basically saying he's open to looking at a rate cut later in calendar year 2025. And we noted on X, it's also good to keep in mind that at the moment, the market is pricing in a 0% probability that the Fed raises rates between now and the end of the year. Why is that relevant? Well, the media keeps telling us that the market is terrified of inflation, and it's only a matter of time before tariffs cause inflation. Well, if market participants really believed inflation was about to get out of hand, they would also believe that the Fed was getting ready to raise interest rates. And that does not align with their positioning in the bond market. Also noteworthy, Nick mentioned that expectations of substantial rate cuts have also diminished. And if you're a stock market bull, for the most part, that's good news. If the Fed never lowers rates, that probably tells us that the economy and the labor market are holding up well. So a relatively muted Fed, 0, 1, or 2 cuts, is probably good news for stock market bulls. Given the S&P 500 has come a long way since the lows that were made in early April, it may be easy to forget that it wasn't that long ago that things were extremely volatile. Tweet from April 6th. It's good for us to remember how helpful lopsided sentiment data was on April 9th. that by Friday, April 11th, we had enough evidence in hand to at least consider that the low had been made. And very, very similar to the bottoming process in 1987, the global financial crisis in 2008 and 2009, and following the COVID crash in 2020, as it turns out, extreme volatility did come at or near the final low in 2025. And the rearview mirror now helps us reinforce that consumer sentiment is just that. It's a sentiment survey. And when it's extremely lopsided in a bearish manner, it can be a contrary indicator. The rare spike and fall in the VIX that we covered on April 14th helped us keep an open mind about a wide range of outcomes, despite the volatility that we had experienced in recent weeks and all of the red screens. And as covered in the April 25th video, we did get a wide range of breadth thrust type signals, increasing the probability that the low was in the rearview mirror. And at the time, all of that seemed to align with, rather than contradict, the thesis that we're in a secular bull market primarily driven by demographics. And we knew in early April that secular bull markets tend to make a stand at or near an upward sloping 200-week moving average. And it's also important for us to keep in mind, walking forward, that even within the context of the strongest trends, all trends, including the current rally off of that April low, experience 100% normal and to be expected give-backs from time to time. The daily chart of the S&P 500 in the short run has a vertical type look to it, telling us to keep an open mind about some normal retracement in the coming days and weeks. Not a prediction in any shape, form, or fashion, but just as we used hard data effectively in early to mid-April, we all know that when things are going well, especially in the short run, human beings tend to get complacent. That's why, maybe more than ever, it's extremely important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.